Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and of course, a touch of crystal ball gazing. Today is Tuesday, April 8th, 2025. Today's episode begins with our headline: The stock market is not crashing, it's reverting towards normal valuations. I've shown this chart a million times and I'm going to show it again. This is the Shiller Cape PE ratio. It represents whether stocks are more expensive than they are traditionally or cheaper than they are traditionally. Obviously, it's a good idea to buy stocks when they're cheap and then sell them when they're expensive, correct? How this determines that is it takes the past 10 years of how much money the companies make. And as a stockholder, you're the owner of the company. What the number represents is how much you have to pay for $1 of return for the company. This chart goes back 150 years about, and you can see sometimes it's obvious that stocks are more expensive in 1900. Sometimes they're very cheap, like in 1921 or in 1932. They're very expensive when they were in 1929. When it's high, it means stocks are expensive. When they're low, it means stocks are cheap. Now, since the 1990s, we have not gone down to what was considered a normal expectation of return for company earnings or anywhere near it. In fact, we've stayed above 15 ever since 1990. Many economists, including myself, are trying to figure out, is this the new norm to stay this elevated, or is it more likely that we'll get back into the range that it's been in for over 100 years previously? As it stands, the Cape-Shiller ratio currently still sits around 31, which is, historically speaking, extremely expensive for stocks. And in order for this to drop down to a normal range, let's say 15 is the normal range, we need a 50% drop to get down there. And that doesn't even include if earnings get lower. Can you imagine if earnings get lower and this ratio goes lower? It's going to be a much greater move than 50%. I know probably most of you watching this show have already heard me explain this a million times, but I can't emphasize how important it is to understand stock valuations. And I am going to repeat, the stock market right now is not crashing, it is reverting towards what is considered to be normal valuations. The crash would be after we get to normal, which probably will happen. But, what do I know? I'm just a guy with a crystal ball. Next headline I wanted to bring up, SMH, the Semiconductor ETF. I see a short opportunity coming. A very powerful chart pattern had developed on SMH. It's called the head and shoulders. You have the shoulder hitting the neckline, the head hitting the neckline. The shoulder, granted, is a little bit of an extended shoulder, and then breaking the neckline and confirming to the downside. Now, I noticed today, intraday, we got all the way back up to 195. If we were to get up to $206 for SMH, that could be a very easy place to go short and make money. This is a perfect setup, and we're in a current environment where a lot of people are doing a lot of dumb things with money, and good, smart traders will are watching this level like a hawk. If we achieve this level, I will be taking actually a pretty large short on the semiconductor industry. Most likely just going long SOXS is the ticker symbol. Next, we have community topics. I love hearing what you guys are doing. It's great. I keep you informed what I'm doing, and you guys can let me know what you're doing. What moves, if any, did you make today? I didn't make any myself, and there's a lot of charts to go through and talk about momentarily. But before we get there, just want to mention coming up, we have the Fed minutes coming out on Wednesday. Hopefully the algorithms know what's going on with the tariffs and don't take this too seriously to make their decisions, because this is obviously going to be pretty irrelevant news to the market. These minutes will likely represent the same thing I put in the cartoon yesterday of Powell sitting in a burning house talking about how employment is strong and inflation is still high, and we're just, obviously not going to cut rates yet. Anyway, also later this week, Thursday, Friday, we have CPI, PPI coming out. And then I decided to move potential opportunities that I see coming into the future into the coming up section. So I moved one of yesterday's titles down here to mention again short VIX opportunity using options. Specifically, it's when the VIX gets over 80. Before we get to the charts, also, I just wanted to make sure to say thanks for watching, subscribing, commenting, and supporting. No changes in the daily reminders. Watch Macro Update to 11:25 to hear me explain them. Also, no major updates in the crystal ball readings, nor the Robschild portfolio explained in Portfolio Update to 11:25. I did a short morning video talking about how, looks like the bounce is continuing, and that got faded. Also, yesterday's video, I said there was potential 5 to 20% move down. Well, if you counted intraday from the high of today to the low of today, that was a 6.6% drop. But not sure if that counts. Obviously, I was talking about if the closing, below the closing price, and we only closed 1.57% lower than yesterday. Now that we're chopping sideways here a little bit, I am wondering if, we'll get some kind of news that will retreat back to this trend line that we broke, and then that would be typical. And then before we get another move to the downside, sort of coinciding with the semiconductor chart that I just showed you. The VIX, the fear gauge, the pricing of options contract, it's looking like this looks bullish to me. This does not look like something cooling off. In order for this to be subsiding, we would first of all want to see a red candle. In other words, it went down over the course of the day. Instead, it opened here and it went up during the course of the day. So we are consolidating sideways after moving up, which is a typical bull flag. So I suspect we will be continuing higher. TLT is in what I call, I believe it's a trader's thing. It's called whipsaw. So it's when things just try to whip everybody out of the market. Whether, you bought TLT here. Nope, we're going down. Oh, you sold it here. Nope, we're going back up. Oh, you bought it here. Nope, we're going back down. So this is just destroying anybody that's trying to trade this successfully. It's a whipsaw pattern here. I am actually, believe it or not, considering getting more TMF at this juncture. Maybe today in after hours. I haven't thought about it enough yet. But the reason I say that is because it's easy for my eye to see that it's pretty likely that this might be the end of this broadening wedge, and the likely outcome will skyrocket to the upside. No advice. This is not advice. I've been noting on many shows the 10-year Treasury note yield coming and breaking down through this pattern. And this is what I mean by whipsaw. So very typical. This is a very strong pattern. Head and shoulders are very, very strong patterns. We broke to the downside. Lots of traders right here when we got to the neckline probably went long TLT or short Treasury note yields, expecting it to go down further, and we pushed right through it, just whipping everybody out of the trade. And the way I look at it, everybody's trying to do the same thing right now. Everybody sees what's going on. It would be unbelievably unlikely for TLT to be dropping in this kind of environment where everyone is scrambling for liquidity at this point, which is what's going on. Margin calls left and right, you name it. There's people getting rich and there's people getting burned. And some people, they're rich one day and they're burned the next. It's a whipsaw. If you know what a whipsaw is, it's two people. It's a two-person saw where you go like this. You hold one end, they hold the other end. You saw something really big with a big tree, and it moves so much, it's just like it's getting everybody. This morning, you may have said, Robschild, you should have sold some of your HYG puts today. What's wrong with you? Look at how much the HYG rose. Well, guess what? During the day, it dropped. The bears took this down. This is a big red flag for the stock market. When credit markets are showing widening of credit spreads, which is what's happening when junk bonds are getting sold off. If companies have debt and they have stock, the stockholders own the company and what's left over in the profits. But the company also has debt, which is a bunch of money that they borrowed that they have to pay interest on. This market says how likely it is that they're going to be able to pay the interest on their borrowed money, never mind what the stockholders are going to get. So it puts the stockholders at much higher risk when something like a junk bond fund such as HYG, HYT, or JNK, for example, is dropping. And the bears are clearly very, very much in control of this market. In other words, it is going down, and it looks like it's going to keep going down. And Robschild's puts are gonna print. Crude oil is seeing a clear worldwide economic slowdown, dropping again. I talked about this morning, I think. I saw, it was this morning. I talked about seeing a bear flag developing, and that quickly turned into simply dropping. A level that some traders are looking at that I'm hearing is around the $53 level. So let's just draw a little line there. That seems to be the downside target. Again, this white trend line more or less has held up for about 4 years, and we broke it and we're going down. This is a big deal for the oil market. A lot of good chartists are suggesting that we may get as low as $35 a barrel for crude oil in the very near future. And I think we're going there. And I've said that I think we're going there actually all the way back here before this run up to, It was, I probably was talking about it back here. But especially here and here, I drew this out. If you watch some of my previous shows, I said we were cracking below it. And we did. So go crystal ball. Also on this morning's show, I mentioned how copper looked like it was turning into a bear flag, and the bear flag did not last very long. Dr. Copper's still dropping. Remember, he has a PhD in economics. You don't want to mess up. You don't want to mess with this guy, especially when you have very large patterns like this developing. Head and shoulders type looking thing. I don't know if we can count that, but this trend line's held up for a long time, and it's not looking so good. So even Dr. Copper's bearish here. We had a shift finally in the Fed funds futures where we're actually almost, because of how turbulent markets have been getting, we're finally 50-50 for a cut in May. Before we were pretty much solidly in the camp that there was no cut for May. In fact, yesterday's probability of no cut was 72%, and that dropped to 54%, and the chance of a cut in May rose from 28 to 46. Granted, we were already pricing in a cut in June, but with all this turmoil, finally the Fed funds futures is like, the Fed's going to have to step in here now. That's what the Fed funds futures traders are saying now. And by the way, Powell will do what the Fed funds futures tell him to do. He tells them what to do, and they tell him what to do. It's a symbiotic relationship. With credit spread spreading, it's no surprise to see this spike on the right side of the screen. This is the upside down version of HYG. When credit spreads are widening, this goes up. I just want to note that as much as the market is flipping out, credit spreads are still tighter than they were at the bottom of 2022. I don't think that will last long, and I'm just bringing that up because it's pretty obvious that credit spreads are going to keep spreading here, and Robschild's HYG puts are going to print. Also, if we zoom out on this chart, look at what was going on in the 1990s. Right now we're at 4.61 spread between junk bonds and treasuries, and 1998 where we're at 6.52. Was there a major recession or something blowing up then. I mean, there's probably something happening in the news, but then we stayed around 5. 4.6 is still, relatively speaking, not super high. You know, you get to the dot-com bubble and we had a peak of 10. Bouncing around in this area between 7.5 and 10. That was like chaos mode before it calmed down to an ultimate low of 2.46 before the Great Financial Crisis, where we peaked at 20. With markets being in such a giant bubble, the way that I look at it, I am afraid to say that this may make the Great Financial Crisis look like child's play compared to what's coming. Also, you know, we always talk about the Great Depression as if that was the worst possible thing that could ever happen. Okay. Well, what about this time? Could something worse happen than the Great Depression? I'm like scared to say those words. And I'm also not afraid to say those words. But what do I know? I'm just a guy with a crystal ball. Sorry for the disorganization. I really want to show this chart alongside the TLT and the TNX to show everybody, okay, yes, long yields went up today. Yeah, people are selling bonds. But again, it's whipsawing. It's not just going up. It's within a pattern. And what gives me so much confidence that the 10-year yield will not continue higher is this chart right here. It's the 10-year break-even inflation rate. This is inflation priced. This is stating, as a matter of fact, there is no inflation coming. Period. This is trillions of dollars betting on the fact that they believe now, as of April 8th, 2025, that the average inflation rate over the next 10 years in the United States will average 2.22%. I cannot emphasize this point enough. This is why I am very, very comfortable in my position, even when it drops tremendously after going up tremendously. I'm very confident that I'm on the right side of the trade. No investment advice. You're watching a guy with silly goggles, a pet dragon, and a crystal ball. So you've been warned. Last chart of the day, Bitcoin. You know, I recently heard a pretty interesting perspective on Bitcoin, saying that, well, Bitcoin actually saw this coming. Funny enough, yeah, look. We had Bitcoin peak all the way back in January, where the stock market didn't reach its final peak. Sorry, the Bitcoin reached its peak in January of 2025, and the stock market didn't reach its peak until halfway through February. And this was going down, not showing and then down way more and down way more. I mean, yes, it is a falling channel, which typically breaks out to the upside, but as it stands, also, take a look at from the beginning of March, we've been sort of sideways in this 80 range. If you check the price of Bitcoin daily, you've been accustomed to seeing it around 80,000 for quite a while now, and very recently, now we're below that at 76,000. I will be very tempted to nibble on a little bit of Bitcoin if we get to 40% off the all-time highs. Just nibbling. And if it goes down further, I will be further accumulating. As much as I generally don't like Bitcoin, it has become a serious asset class in the world that cannot be ignored. And when it seems overly cheap, like if it's 50% off, well, that's how I play the game. But what I know, I'm just a guy with a crystal ball. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.